Welcome back to the deep dive. If you've been anywhere near the crypto markets recently, you know the atmosphere is, less than serene.
Less than serene is putting it mildly.
Right. There's a palpable anxiety, a low-frequency hum of fear, and it's centered almost entirely on Bitcoin. We're hearing whispers everywhere. The biggest fish in the pool, the whales, are dumping their holdings, and this entire bull run is about to be washed out to sea.
And it's that classic market panic feedback loop, isn't it? Where emotion just completely outweighs analysis.
Exactly.
You get a significant price dip, you combine it with a few massive, very visible transactions on the blockchain, and it just sends the whole community into a frenzy.
Well, our job today is to ignore that sensationalism, to try and turn off the noise and look at the cold, hard data. We've got analysis from some of the most rigorous on-chain firms out there.
And we're really on a mission to answer one question precisely. Is this recent spike in whale activity a definitive structural signal that the current bull cycle is collapsing?
Or is it a sign of something much more predictable and maybe even calculated?
That's the question.
Okay, that's our mission. But before we get into the $237 million transfer that caused all the trouble, let's make sure everyone is on the same page. When we use this term whale, what exactly are we defining? Because it feels like it's more than just someone with a lot of Bitcoin.
It is, that's right. A whale is defined not just by the sheer volume they hold, but by the gravitational impact they have on the market.
Okay.
So it's an entity, it could be a high net worth individual, a fund, an institution holding an enormously large amount of Bitcoin.
Huh?
But the critical component is that their movements, whether they are, accumulating or, more worryingly, distributing their supply, are large enough to cause a visible shift in the market price and profoundly affect sentiment.
So their actions are seen as a leading indicator.
Precisely. The wider market looks at what they do and tries to guess what's coming next.
And we just saw one of those actions spark this latest wave of panic. Okay, let's unpack this and start with a specific event that set the entire market on edge. So the overarching narrative in the media has been this wave of selling. The fear is that these gargantuan investors are moving past simple profit-taking.
Right.
And are actively leaving the crypto game, suggesting they see some sort of fundamental deterioration in the asset's prospects. And this urgency really reached a breaking point last week with a truly remarkable transfer.
Well, because Bitcoin's ledger is transparent, large movements like this just don't go unnoticed. Last Thursday, the blockchain analytics platform Arkham immediately flagged a transfer that was so large, it momentarily seized up social media chatter across the entire crypto sphere.
It just took over everything.
It became the dominant fearful headline for like a full 24 hours.
And the details of that transfer are critical. This wasn't just some anonymous wallet moving coins around.
No, it was identified very quickly as belonging to a major trader, Owen Gundon.
And the number that matters. Exactly 2,400 Bitcoin, moved in a single chunk.
A phenomenal amount. When that transfer occurred, 2,400 Bitcoin equated to a valuation of approximately $237 million.
I mean, just to put that in perspective, that's approaching $250 million, moved in a few seconds.
The sheer size of the move alone is enough to justify the attention. But what really heightened the anxiety, as you said, was the destination.
Where did it go?
It was sent directly to the Kraken cryptocurrency exchange.
And that destination is the fear factor multiplier. If I'm a high net worth individual and I have $250 million in Bitcoin, moving it to an exchange, that just strongly implies that liquidity is about to hit the market.
It does.
What is the standard negative interpretation of moving $237 million into a liquid trading environment?
The initial interpretation is almost always catastrophic in the short term. An exchange is the final gateway, to fiat currency or to large immediate trades. So when such a huge sum is moved there, the assumption is that the next step is execution.
Meaning selling.
Meaning selling. This one move prompted widespread rumors of capitulation, suggesting that a leading whale was exiting, signaling that they had seen the top. The fear is that Gundon knows something the average person doesn't, and he's getting out before the crash.
But wait a minute, that's what I don't get.
Yep.
If Owen Gundon is a highly sophisticated trader, managing a position of that size,
A $237 million position, yeah.
why on earth would he send it to a public exchange like Kraken, where it's guaranteed to be flagged by Arkham and spook the market?
That is a brilliant point.
Doesn't the very existence of over-the-counter or OTC desks allow him to sell that quantity quietly without any price impact?
It does, and you've just introduced a necessary level of skepticism to the whole narrative. If Gunden's sole objective was to quietly cash out $237 million into USD, he absolutely would use an OTC desk.
Right.
An OTC desk facilitates huge transactions completely off the public order books, ensuring there's no immediate market impact. So moving it to Kraken suggests one of several alternative intentions, and this is where the nuance is just critical.
Okay, so what else could it be?
Well, first, he might be moving it to be used as collateral for leverage trading or borrowing on the exchange, not necessarily selling.
Ah, so he's using the asset to trade more, not get rid of it.
Potentially. Second, if he did intend to sell, moving it to a liquid public exchange could signal that he's not concerned about the immediate price drop. Perhaps he thinks the market can absorb it. Or maybe he wants to contribute to short-term volatility to execute a more complex, multi-layered hedging or arbitrage strategy. The initial fear narrative, he's panic dumping, is just too simplistic when you consider that OTC options were easily available to him.
That reframes the situation instantly. But the core fear for the everyday listener remains, though. Does a move this large, regardless of intent, still indicate that the biggest players are shifting their positions fundamentally and signaling an impending market collapse?
That is the fear, yes. It suggests that the veterans are throwing in the towel. But this is exactly where the professional on-chain data analysts step in and say, hold on, let's analyze the long-term flow patterns, not just the single headline event.
Right.
We need to see if this gun and transfer is an isolated panic, or if it perfectly aligns with a much larger and ultimately predictable structural cycle that has been developing for months.
And here's where it gets really interesting. We introduced the first major data-driven counter-narrative, and it's coming from the highly respected on-chain data firm, Glassnode. They looked at the Gundan transfer, they looked at the broader wave of selling, and they concluded that the market is completely misinterpreting the evidence.
Glassnode's argument is one of necessary historical perspective. They argue that this recent selling wave is not sudden, random, or unusual. Instead, they classify it as a typical textbook phenomenon that is observed every single time a crypto cycle enters its late-stage phase.
So they're basically telling the market to stop panicking.
They are. They're saying the data confirms this is a structural distribution of wealth, not a random, fearful exodus.
So they are making a fundamental differentiation between impulsive selling and calculated selling. It's not just dumping.
Exactly. Glassnode insists that the reality is far more sophisticated than the simple headline whales dumping. To really understand their analysis, we have to look at their crucial cohort, the long-term holder, or LTH data. This group is the heart of the cycle analysis.
LTHs. These are the veterans, the so-called diamond hands. But how exactly does Glassnode define a long-term holder? Is it just someone who has held for, say, a year?
This is a critical technical distinction that often gets lost in high-level summaries. Glassnode's methodology defines an LTH as an entity that has held their Bitcoin continuously for 155 days or more.
155 days, why that specific number?
Well, historically, this length of holding period is used as a statistical threshold to filter out the short-term speculators and transient market noise. If you've held your coins for 5 months, you've likely weathered at least one significant volatility event or a correction.
So it demonstrates a commitment that suggests a deeper conviction.
Exactly. It separates the tourists from the residents, so to speak.
So these are the people who bought Bitcoin a long time ago, they held it through the bear market, and now they're sitting on substantial gains. What does the LTH outflow data specifically show about their activity recently?
The data is unambiguous. The outflow, so the amount of Bitcoin sold from this LTH group, has increased significantly.
How significantly?
We can put precise numbers on this distribution pressure. In early July, the LTH daily outflow was running at just over 12,000 BTC per day. As of last Thursday, when the Gundan transfer happened, that daily volume had doubled to approximately 26,000 BTC per day.
Wow, a doubling of daily selling volume?
That doubling is the observable reality of distribution.
Okay, doubling the sales volume from the most dedicated holders. That sounds profoundly bearish, even if the selling is structural. So why is Glassnode not concerned by this massive uptick? What's the critical nuance that makes this calculated rather than panic?
The critical difference lies in the rate and consistency of the distribution. Glassnode noted that this increase has been happening steadily and evenly spaced.
Okay, so it's not a spike.
It's the opposite of panic. Panic selling is sharp, violent, erratic. It's characterized by massive, one-off spikes, usually driven by sudden fear or some negative news. What we are observing, according to their metrics, is a slow, continuous ramp-up of selling pressure.
Like turning up a dial instead of flipping a switch?
That's a perfect way to put it. This behavior is the telltale sign of calculated profit-taking. It's a strategy designed to monetize your holdings over time without crashing the underlying asset.
Right, because if they were panicking, they'd all sell at once.
They'd all rush for the exit simultaneously, regardless of the market impact. But since the distribution is steady, it suggests coordination and strategy.
This brings us back to that famous analogy, which is so effective at making this abstract data relatable. The farmer harvesting fruit. It perfectly describes what Glassnode is seeing.
It absolutely does. Think of yourself as that farmer who planted a Bitcoin tree years ago and nurtured it through the brutal crypto winter. Now, after years of patience, that tree is overflowing with ripe, high-value fruit.
Oh, okay.
A panicking farmer would take a chainsaw and chop down the entire tree to get whatever cash they could instantly. But a strategic, long-term farmer, they understand that the tree is a valuable perennial asset.
You don't kill the golden goose.
Exactly. The strategic farmer, the LTH, does not liquidate their source of wealth. Instead, they harvest the most ripe fruit, the highest profit margin coins, gradually and steadily. They bring measured batches to the market over days and weeks. This steady distribution maximizes their return while ensuring the underlying asset remains healthy for future growth.
So the LTHs are simply monetizing the successful culmination of years of investment patience.
That's it. We're transforming the narrative from whales running away from a sinking ship to whales realizing the reward for a job well done over a multi-year period.
So Glassnode confirms the structural finding.
They do. They concluded that this stable, steady increase in outflow reflects increasing distribution pressure from the older investor group, a typical model of profit-taking at the end of a cycle. And most importantly, this exact pattern has been consistent with the distribution behavior observed in every previous major cycle top.
It's written into the crypto cycle rulebook.
In a way, yes. It's predictable.
Which begs the final crucial question in this segment. If the seasoned veterans are systematically selling 26,000 BTC a day, then who structurally is absorbing that supply? Who is on the other side of that $250 million trade?
That supply rotation is the key dynamic of a late-stage bull market. Typically, the supply sold by the seasoned LTHs is absorbed by two main groups.
Okay.
First, the retail investors who are just entering the market, drawn in by the media hype and the final legs of the bull run. And second, short-term holders, STHs, defined as those who've held their coins for less than 155 days, are often the new money flowing in, eager to participate in what they believe is the market's continued ascent.
So it represents a fundamental rotation of ownership from old, profitable hands to new, eager hands.
That's the cycle in a nutshell.
Okay, so Glassnode provides reassurance that this is rotation, not random chaos. However, they use the term late cycle stage. This brings us to the next critical layer of analysis. If we are in the late cycle stage, does that automatically translate to an imminent market peak or a collapse?
That is the crucial distinction we have to make. And here we need the insights of Vincent Liu, who's the Chief Investment Officer at Kronos Research, a major quantitative trading firm.
And what's his take?
Liu completely supports the structural assessment. He described the whale sell-off not as a panic event, but as a stable profit rotation. He notes that the clear signs of this late cycle stage are everywhere. Increased realized profits among long-term holders and a stable underlying liquidity environment.
But Liu offers a powerful caveat. He pushes back strongly against the idea that late cycle means the party is over tomorrow. What's his critical nuance regarding the peak?
His crucial point is this, and I'm quoting, "This late cycle stage does not necessarily mean the market has peaked." Liu argues forcefully that a cycle often enters a cool-down period, a reduction in its frantic upward momentum that can last for a prolonged period without immediately hitting a final top and collapsing.
So the top isn't a single point in time, it's more like a plateau.
It can be. The simple mechanism for him is this. The market is not considered to have topped as long as there is sufficient stable new liquidity and capital actively absorbing the supply being sold by the whales.
So the market shifts gears. The days of, parabolic growth driven by internal crypto enthusiasm, they're over for now. But if that internal momentum has slowed down, what exactly is driving the price movements in this late cycle cooling period?
Liu explains that once the internal organic euphoria fades, the market dynamic shifts entirely. In the late cycle, Bitcoin's movement is driven almost exclusively by two external forces: macroeconomic factors and global liquidity.
It becomes less of a self-contained entity.
And more of a risk asset that's sensitive to the world's financial plumbing.
Okay, let's detail those macro factors. What specific global economic pressures did Liu cite as currently influencing Bitcoin's price and slowing down its trajectory?
He cited two primary interconnected pressures related to central bank policy and global conditions. First, there are shifting interest rate expectations, specifically the reduced expectation for sharp, immediate, or sustained rate cuts by major central banks.
Higher for longer.
Exactly. When interest rates remain higher for longer, it starves the global system of the cheap liquidity that often floods into risk assets like Bitcoin. And second, he pointed to broader short-term weakness or uncertainty in the global economy, which just generally dampens investor appetite for highly volatile assets.
So the impact of these factors, according to Liu, is to act as a systemic headwind.
That's right, they slow down the upward momentum, acting like a constant brake on the engine, but they are not, on their own, powerful enough to sink Bitcoin entirely, provided the structural absorption of supply, the new buyers, remains intact.
That brings us to technical analysis. To try and gauge the immediate pain points, did Liu reference any specific on-chain technical indicator that we can use to locate where we are in terms of potential bottom formation?
He did, yes. He brought up one of the most powerful cyclical indicators, the Bitcoin Net Unrealized Profit Loss Ratio, or NUPL. He reported that this key indicator is currently sitting at 0.476.
Okay, NUPL. For those who might have heard of it but don't live and breathe on-chain metrics, let's quickly define it and then contextualize that number. NUPL measures the difference between unrealized profit,
So coins held at a gain,
and unrealized loss, coins held at a loss divided by the market cap. It's essentially a measure of collective market emotion, tracking when the majority of investors are feeling profitable versus fearful.
That's a great summary. And the power of NUPL comes from dividing its historical range into key psychological zones, which are color-coded in Glassnode's charts and have historically pinpointed cycle stages. We have to understand these zones to appreciate where 0.476 sits.
Okay, walk us through them.
So you have Zone 1, capitulation, deep red. This is the absolute bottom where NUPL is close to or below zero. Pretty much everyone is underwater.
Bad place to be.
The worst. Then you get Zone 2, hope, fear. That's orange and yellow. This is the transitional phase, generally running from about 0.25 up to 0.5. This is where the market starts to hope again, but fear still dominates any corrections.
And after that?
Zone 3, optimism. Light green, the majority are profitable, from 0.5 up to 0.75. And finally, Zone 4, belief euphoria. Dark green and blue. That's the peak territory, typically above 0.75.
So if the NUTL ratio is currently at 0.476, where does that put us in terms of psychological state?
The reading of 0.476 places us squarely in the upper end of the hope-fear zone, Zone 2.
Okay.
And this is crucial context. It means that while the market has taken a beating and momentum has cooled significantly, we are technically hovering just below the 0.5 threshold, the point where the market shifts into broad optimism.
So what does that signal to him?
According to Liu, that specific reading signals that a potential short-term bottom may be in the process of forming right now. It suggests that the recent market dip is pushing investors to the brink of that hope-fear boundary, which often provides a strategic area where downward pressure temporarily stabilizes.
An inflection point, not a catastrophe.
Exactly. But he was very clear. This indicator needs to be confirmed by several other macro and on-chain metrics before you can go out and declare a firm bottom. It's just one piece of the puzzle.
The conversation so far leans towards structural rotation and macro cooling. Now we have to shift to the most deeply ingrained theory in the entire crypto space, the 4-year cycle. This pattern, often associated with the halving, is, well, it's gospel to many long-term holders.
It really is. And to explore the power of this historical rhythm, we turn to Charlie Sherry, the finance director at the Australian exchange BTC Markets. Now, Sherry first agrees with the earlier assessment that isolated whale sales, like the one from Owen Gundon, are usually just noise and should be discounted.
But Sherry did raise a very specific structural flag regarding Gundon's transfer, didn't he? What was his primary concern that moved him toward the idea of a potential top?
His concern wasn't the seller, but the lack of resilience in the buyers. He noted the pronounced lack of significant buyer support necessary to immediately absorb that $250 million sale.
Meaning the market should have eaten that sell order up.
Right. If new, eager money was truly flooding the market, a $237 million transfer should have been quickly swallowed up with minimal price disruption. The fact that the price stalled and struggled afterwards suggests that the new investor class, the STHs that Glassnode mentioned, might be running low on conviction or capital right now.
So because the buying pressure looked weak, he's more worried.
Exactly. And so, while cautioning that it was too early to confirm, Sherry stated that the possibility of a cycle top being in, based on this lack of demand absorption, is indeed plausible.
And that plausibility is heavily anchored in the historical data, particularly the uncanny way previous market peaks have aligned chronologically. Let's review those precise numbers that give the 4-year cycle its near mythological status.
This is where it gets really interesting. Sherry provided compelling evidence demonstrating that historically, Bitcoin market peaks have occurred with shocking consistency when you measure from the absolute bottom of the preceding cycle.
Okay, let's hear them.
First historical point. The famed 2017 peak occurred exactly 1,067 days after its preceding major bear market bottom.
1,067 days.
Okay. Second historical point. The subsequent 2021 peak occurred 1,058 days after its previous bottom.
Getting closer.
And the third historical point. The most recent all-time high, which he dates specifically to October 6, 2025, occurred 1,050 days after the last major bottom.
I have to stop you there. Those numbers, 1,067, 1,058, and 1,050 days, they're almost identical, spread out across nearly a decade of market development.
It's uncanny.
We're talking about tops happening within a 17-day window over a 4-year period. That kind of statistical consistency is what makes pattern recognition so tempting and so powerful for investors who trade based on repeating cycles.
It creates a narrative framework that is extremely difficult to ignore. If you trust pattern recognition, you look at those data points and conclude that Bitcoin cycles operate like clockwork, that they follow a rhythm dictated by the halving and subsequent investor psychology, regardless of what's happening globally.
But this is where we have to introduce some critical friction. That clockwork pattern relies heavily on one crucial and sometimes subjective starting point, defining the exact bottom of a multi-month bear market.
That's a very sophisticated challenge to the data.
Given how messy and volatile crypto bottoms can be, how sure can we actually be about the precision of that 1,050-day starting point? Isn't there a risk we're miscounting?
There absolutely is, and it's why Sherry's analysis, while compelling, has to be viewed through a skeptical lens. On-chain analysts often use multiple methodologies to define the absolute low, like the net realized profit-loss floor or the highest point of minor capitulation.
And they don't always agree.
They don't. Slight variations in the definition of the bottom day can shift the count by weeks. And if the true bottom was misidentified by even 2 weeks, that 1,050-day alignment loses some of its predictive power. It becomes less a law and more a guideline.
But still, based purely on the historical cadence they derived, what was Sherry's conclusion?
His ultimate historical conclusion is that it is possible that we have passed this cycle and are entering the early stages of a bear market. He presents this as a clear, data-backed downside scenario. If history holds sway, what we just experienced in the market was the cycle top, and the distribution we are seeing is the start of the next long, cold winter.
So we have two completely opposed viewpoints based on the data. Glassnode and Liu see a structural, calculated rotation and a macro-induced cooldown.
And Sherry sees an uncanny historical alignment, suggesting the top is already in, pending confirmation of weak buyer demand. It's a fascinating split. And this collision of views brings us to the final, most forward-looking piece of analysis, the challenge to the 4-year rhythm itself.
Right, because while Charlie Sherry presented that compelling historical alignment, he immediately provided a critical caveat.
He did. He said the 4-year cycle concept is not inviolable.
Why? I mean, after showing such statistically tight alignment over 3 cycles, why should we suddenly doubt the pattern? What is the fundamental change in market structure that could break the rhythm this time?
There are 2 main reasons. First, as we just discussed, Bitcoin's history is short. 3 data points, 3 cycles, that's not enough to confirm a robust statistical law.
True.
But second, and vastly more important, the fundamental market dynamics have changed drastically since the 2017 peak, and even significantly since the 2021 peak. The players and the money flows are fundamentally different.
And these new players, of course, are the colossal traditional financial institutions entering the market via regulated products.
Exactly. The new entities that are fundamentally changing the market's rhythm are the exchange-traded funds, ETFs, and the associated institutional players dealing in large corporate bonds and derivatives tied to Bitcoin.
These are not individual retail traders.
Nor are they original tech-focused whales like Gundin. These are massive, risk-averse, regulated traditional financial organizations.
And why does this change in player matter so much that it could override that historic 4-year pattern? I mean, the previous cycles were driven by the predictable emotional swing from fear to euphoria, often triggered by the halving supply shock.
The institutional flow operates on a completely different timetable. Sherry's point is that these buyers do not trade according to the 4-year cycle or rhythm. They have their own structural drivers. The core difference lies in the nature of their demand. It is non-discretionary and often continuous.
Okay, what does non-discretionary mean in this context?
Think about the mechanics of an ETF. If a major institutional client allocates new capital to a Bitcoin ETF today, the fund manager has a non-negotiable obligation to immediately enter the market and purchase Bitcoin equivalent to those inflows.
They have to buy.
They have to. This happens every single trading day, regardless of whether it's 1,050 days or 1,100 days after the last cycle bottom. This creates a relentless underlying demand floor that was completely absent in previous retail-driven cycles.
So previous cycles were driven by these bursts of demand FOMO, followed by massive periods of low demand and capitulation.
Right.
And institutional demand could smooth that volatility out by creating a stable absorption mechanism.
That's the theory. These institutional players are driven by quarterly rebalancing requirements, annual client mandates, regulatory approval cycles, and macroeconomic interest rate curves, none of which align with the 4-year halving-centric schedule. If their clients keep pouring money into the product, they keep buying Bitcoin, potentially absorbing the selling pressure of the LTHs and preventing a deep, prolonged bear market.
Thereby breaking the 1,050-day rhythm.
Potentially, yes.
But we have to assess the current state of that institutional interest. Are they still buying strong enough to counteract the LTH distribution?
Well, Sherry noted that demand from these institutional players has recently weakened. This slackening of institutional demand is precisely what contributed to that lack of buyer support he identified following the Gundan transfer.
Ah, okay.
This weakening suggests that the new, non-cyclical structural support may not be powerful enough to fully overcome the historical patterns of profit-taking just yet.
So it's a moment of tension. The market has changed its structure, but that new structure is currently struggling to absorb the old structure's profit-taking.
That's a perfect summary. Sherry's final conclusion is thus highly nuanced. Only time will tell if the recent peak was the cycle peak. While he acknowledges the profound historical evidence suggesting we should be entering a bear market right now, he maintains that the structural evolution, the institutionalization of the asset, provides fundamental reasons why Bitcoin should no longer adhere to the 4-year beat.
But the core conflict is?
The core conflict is that the strength of those fundamentals is being challenged right now by the macro headwinds and the sheer volume of LTH distribution.
That leaves us with a high-stakes battle. Historical pattern recognition versus modern institutional market evolution. So we have navigated the emotional turmoil of the Gundan whale transfer. We've dissected the structural rotation identified by Glassnode, contextualized the macro headwinds from Kronos Research, and grappled with the eerie 4-year cadence presented by BTC Markets. What does this mountain of data mean for you, the individual learner who is just trying to maintain perspective?
The most critical knowledge derived from this deep dive is not about timing a top or a bottom, but about managing your own psychology by understanding these massive underlying dynamics. When the noise hits, you need a framework to interpret it.
Right.
And we can draw 3 concrete, crucial pieces of advice from the collective insights of these expert sources, designed to stabilize your decision-making in the face of all this volatility.
Okay, let's start with the one that combats the immediate panic generated by headlines like the Gundan transfer.
Number 1. Maintain emotional distance and see the strategy. The core lesson from Glassnode's LTH analysis is paramount. When you see a sensational headline about a massive whale dump, remember the farmer harvesting fruit analogy. That whale's action is likely part of a long-term calculated strategy designed to maximize profit after years of holding. Their strategy, driven by multi-cycle gains, is entirely different from yours. Don't confuse their structured profit-taking, which is a function of a maturing cycle, for a signal of market collapse or personal capitulation. Your response should be informed by data, not instant fear.
Okay, solid advice. The second piece of advice is crucial, adjusting the why behind your presence in this volatile market.
Number 2, define and solidify your time horizon. You must clearly and honestly ask yourself, why are you holding Bitcoin? Are you focused on the core long-term vision, the technology, the decentralized future, the store of value function, measuring success in years or decades?
Or are you here for a quick flip?
Or are you focused on short-term speculation, trying to capture the next 30% swing? If you are a long-term structurally minded believer, these cyclical distributions and whale sales become simply noise that you can filter out.
Right.
If you don't anchor your investment to a robust long-term thesis, any headline will cause you to sell at the worst possible moment.
And the final piece, which I think really sums up the spirit of this deep dive.
Number 3, demand nuance and context. Never allow a single data point or sensational headline like the NUPL number .476 or the Gundan transfer to dictate your strategy. You have to seek out and synthesize multiple, sometimes contradictory sources of analysis.
Like we did today.
Exactly. Understanding that a late cycle does not automatically equal an imminent peak, or that historical patterns are being challenged by the flow mechanics of institutional ETFs, is what allows you to survive these periods of volatility. The nuance is the armor that protects you from making expensive, emotionally driven mistakes.
Ultimately, the most powerful takeaway is that the market requires emotional discipline above all else. Understanding the sophisticated game the multi-million-dollar whales are playing allows you to manage your own risk exposure, which is always more critical than trying to guess their next immediate trade.
And that framework leads us to the final provocative thought we want to leave you with. We were at a historic juncture where two titans are clashing. On one side, we have the ancient, proven patterns of the 4-year human emotion cycle, fear, greed, and the predictable effects of the halving.
And on the other side?
On the other side, we have the sheer gravitational financial power of institutional capital and the structural stability offered by products like ETFs. So the question is the new institutional interest powerful enough to permanently break the historical 4-year cycle, creating a new, slower, steadier market? Or will the psychological patterns of panic and euphoria ultimately prove too strong, regardless of who is trading? We look forward to seeing which force wins the day in the coming months.
A truly compelling conflict to observe. Thank you for joining us for this deep dive into the whales, the cycles, and the $250 million question hanging over the market. We'll see you next time.